Sorry for the delays. I forgot to start the stream. And click that button there. I always go live 15 minutes before. I was on Beat the Bell show this morning with King Capital folks. Really fun. So let's get rolling. And I'm just sitting here like, okay, market's about to open, and I'm like, all right, I'm ready. Wait, where's all the viewers? Where's my YouTube? Oh crap. That don't mean I forgot about y'all. I never forget about you guys. I love y'all way too much. Promise. Who could forget about the Rock Suiter crew? What else? Smash that like button. All right, we have a new release today. A couple of patches. So every day you're gonna see new patches coming through. This is great. New patches are going to be just kind of tidying up things the next couple months. We're all we'll be doing is tidying up the platform. So after the alerts come out, which are actually now, we should have DD band alerts. Starting today. I think those just came out. Markets opening inside of DD bands. You have NASDAQ. I'm just going through this really quick. Gonna open the market. We have S&P. We have Russell up here. So market's nice and stable again. If it's a bull trade, I can trade up to DD bands. VIX and decay below triple B. Nice, clean, easy pivots. I alert my platform. There we go. The alerts are there. Let's go. Perfect. So DD band break alerts released today to production server. You're live. For those of you that have your futures data attached, you will see those alerts. I'm excited. Let's go. We got the S&P right here. Sorry, right here. The watch list itself is still a little... Oh, they're starting to load the new platform face. And the platform even looks different. That's coming out in little pieces as well. So the platform's gonna get a change of look as well, everybody. You might notice that. The fonts and things and colors are gonna look slightly different. So new face of the platform launching this week as well. New look and feel, better arrangement. It's gonna be nice. The design is sweet. I know, because I designed it myself. Well, okay, I'm lying. I assisted designing it with our UX guy who built a beautiful piece of art. William says not able to load the charts. Log out and log back in, man. You should be good. Every time there's a new release, you have to log out and log back in. It should kick you out, but you should be fine. Let's find out here. All right, let's go. Ricky, right out the door. I got liquidity maps coming through. Let's look at resiliences are positive. Looking pretty solid there. Let's get resilience on the chart. All right, so it looks like right out the door, I am looking to get a... Here we go. Liquidity maps popping up right now. Let's take a look at what we have. We have a bull long up on QQQ looking great. SPY, let's take a look at that. Might be ready to... okay. My quickie little long out the door. So my futures candles are here. All right. All right. So nice long out the door, looking great. Things are looking good. Everybody smash that like button if you can. We'll check the NASDAQ, looking good. So inside DD bands there. So we have DD band break alerts just now released today. This is exciting. I'm gonna write the announcement there. All right, so today's specific trade setup looking great. Man, I'm loving the platform more and more every day. We have so many new things coming out. All right. As a matter of fact, all right. Well, nice little update today. I think we might tap DD bands again. All right, so here's the trade. Oh, here's a big old fat green. All right, here, watch my screen, everybody. Upper DD band is the target we look for whenever you have a nice bull long up with nice bullish signals. You have DD being positive, 99. So DD means that the bull zone is support. You have a bull long up, which means open, blue open is support. And then, of course, outside of the box, you have mode 2 resilience. With resilience greater than 0, this is support to trade higher. So we're looking for the market to, roughly speaking, I'd say that probably this is where hedge pressure is, right? Give or take on SPY. So we're looking for the market to press in that direction. Easy peasy. Love it, love it, love it. William, and it says not able to load charts. You gotta take a picture of what you see. Post and tech support will immediately jump on that for you, man. The background's a bit darker, yeah. So the new face of the platform is gonna start coming out. I guess in pieces. I'll tell you the whole thing. All right, you guys, I like this today. Looking really good. Let's get some stocks right out the door. Let's look at UVXY actually first. I honestly, they didn't tell me they were releasing anything related to the new look and feel yet. So I didn't get that note. They were trying to release it, but then they pulled some of it out. So I think that maybe they went to release it and pulled some of it out, but forgot to pull all of it out. So it looks like we got a little taste and flavor of the new release. All right, we're bare long up on UVXY, which is great. Just keep in mind that whenever VIX hits a pivot that can push volatility higher, as we trade up today, if VIX is in decline, just remember, anytime you hit a pivot in a bull market, you can expect volatility. So like on the way up, as soon as UVXY hits a hedge pressure pivot, will be your first red candle if you're looking to get in. Merge in small increments. Oh, okay, cool. Okay. All right. Here we go. We got our first set of red candles here. This is looking great. All right. Let's see if we get it. All right. Thoughts on Caterpillar? Let's take a look at that. All right, Cat. All right, so let's talk about some fundamental data. Remember, yesterday we had the JOLTS come out, and yesterday we had the consumer confidence numbers. Both of those came out pretty decent, supporting a slightly less, bad economy. And in those cases, with JOLTS coming down and continuing jobless claims, which comes out every Thursday, which come out tomorrow, have also been trending down. It just shows that people are going back to work, which implies that workers that wanted a higher wage for their job are now accepting a lower wage for their job as companies are increasing their performance. Quarter over quarter, companies' earnings are looking pretty decent. It means that the companies are likely lowering their bottom line and paying these people less salary for the jobs. As people are getting desperate in unemployment to take a job at a lower salary, which is bringing inflation down, which also matches CPI. Now today, metric number 2 that I love to look at to show that there is just no immediate downfall or slowdown or recession looming is the quarter over quarter GDP growth. You always look for these things. Let's look at these numbers here. Non-farm employment, ADP non-farm. So let's look at that real quick. But the GDP is very important right here. Quarter over quarter GDP growth. As long as GDP growth is positive, you're growing. People are actually making something, and building something and creating things, and we're actually buying things from them. I mean, GDP growth goes negative in market crash in terrible environments, and a lot of times you'll have GDP surging. Let's look back here in 2008. In periods of huge bump, and then you go negative. This is obviously October 2008. This is right after the market crash. You can see that everything just kind of slowed down for about a year. And that's what you'll see. And then, of course, the tiny little, mini recessions we've had, like COVID and things like that, you'll see that GDP growth also was negative. This is not the GDP itself. This is the growth quarter over quarter. So measuring the difference between two quarters. So when you have that growth positive, your GDP just doesn't grow in a recession. I mean, while it's not like it's steady above 2%, it's less growth than we saw post COVID. But I mean, you can see right here, it's still hanging in there. It's the expectation was much higher, and we lost against the forecast. But the forecast is just overestimating what it should be. I mean, it's 2% or higher. 2% growth is great. You cannot argue with that. Gabe, love having liquidity map reference to sidebar. Such a simple yet great addition. Hey man, we appreciate you guys, and thanks for supporting our platform. Supporting our development, supporting our drive. All the things we're building. Make sure you tell all your friends as we continue to grow the platform. We have better, cooler features coming out as the years go by. I'm excited to share all that with you guys. So those of you that did not get into the Pro Plus to have DD bands and DD band breaks as the new alerts, that's super exciting. That's actually a brand new feature. You guys can smash that like button on the stream really quick. There's also a known glitch in the watch list that is freezing the platform. So just don't use the watch list until tomorrow. That's one of the things we're working on. All right. How did you record your Zoom? Did you record? Yeah, I recorded yesterday's Zoom call, and I'll post it today. Recorded Zoom calls are now going to be a feature of Pro Plus as well. I'm going to make that channel for you guys really quick. So right now, market's going to, if you guys have some tickers you want me to run, post them up here really quick. And I want everybody, do me a favor, smash that like button right now. Smash, smash, smash. I'm going to put up a new thing. So we're finally going to do recorded Zoom calls. Okay. But again, like everything else, you must be Pro Plus. We're going to do Zoom recordings. Remember, the features are going to be extended features that are going to be for folks that are in the higher tier package. We have to have like a reason for that package to exist. So that's also a new Pro Plus feature starting today. I forgot to make the channel, and I just now made the channel. All right. Okay. All right. Pro Plus done. All right, and it is there. I will upload. Oops. So most relevant Zoom calls will be put in there, not like any one of them that have to do with like, if it has to do with like a trading day or You know, just like a trade plan or something. And relevant ones, yeah, if we're just kind of meeting for like random stuff, no. So essentially the Zoom calls on a daily basis that we do that have substance in them, not just like a team meeting or something, we'll post those Zoom calls there. All right. That's right. My personal chef just came in here, brought me some bacon and eggs, and there's no bread because I'm trying to lose weight. Get my blood pressure down. I was taking blood pressure meds for a little bit. Let me tell you something. Fuck blood pressure meds. And I know I should probably take them because I'll probably die if I don't. But I'm going to take a healthy approach and try to like lose weight and eat better and have less stress. So none of y'all fucking stress me out anymore. Y'all give me some, y'all gotta be kind to Papa Paradise. Okay. Because I gotta keep my blood pressure down. So I'm trying to eat better, less salt, work out 1-2 times a day. And hopefully that gets my blood pressure down because I'm not gonna lie. Y'all gonna kill me. The stock market's gonna kill me for sure. This is in the channel. Oh yeah. Zoom recordings. And only available if you have Pro Plus. Starting today. And some of the Zoom recordings will be posted as part of the lesson plans as we continue to grow those lesson plans. Oh yeah. You ever done an extended fast? No, what is that? I haven't done that. I mean, I know what that is, but like, how long? What are the rules of that? All right, net power. Okay, MK. Did you cook it in the pan or in the oven? The toaster oven? Mmm. Well, that's delightful. I don't know if we have any data for net power. Don't have. Let me see if there's monthly. It's the perfect day, guys. This is all golden setup. DD bullish, resilience greater than 0. All the lights are green. This is a perfect golden setup day. Bullish top DD band. It's gonna be great. Oh my god, so good. But everything bagel seasoning. Oh, is that pepper? Oh yeah. I've got this new flavor like that I love. Eating plain eggs with like no salt or no seasoning, nothing, just like straight plain. I'm not raw dogging that shit, but it's good. Sending healthy love you real time. Now so monthly maps doesn't look that great until mid-September. Let's show monthly maps really quick. Let's just do it down here at the bottom. So actually think of it like this. Monthly maps actually look great, period, in general. Let's analyze what we have. Right. So let's make this bigger so you can see. Actually, let's just clean all this up. Okay. So here's how to read the monthly maps, right? What you want to do, and I'm just gonna just show y'all really quick. Let's just draw. Let's have an art project day. This is your bull zone. It's your bear zone. So far, so good. So what you're looking for is you're connecting the dots. And one of these days we'll have some more information on here, like our algorithm that tries to connect the dots is very weak because we just threw it together and we haven't circled back on it to make it look better. But your brain is supposed to connect the dots on your own, just like this. Because what happens if there's multiple zone switches, it kind of throws it off. And we didn't write the code to really deal with that yet because we're going to reface monthly maps to have all kind of extra information. And so with the monthly maps reface project, it's going to basically draw all this on the chart for you. So what you're looking to accomplish here is the following. You're going to connect the dots at the bottom of the bull side and the top of the bear side, just like that. So bottom of the bull side is like this, okay? And if the bottom of the bull side is sloping down at the current price, you can see that there's just more bulls over time in the money. Does this make sense how it works? So like an example is right here on this day, my mouse is at 444. 444 calls are in the money this day. One day later, 440 are in the money. So at least between here and here, you have more people that are going to expire in the money that have to get in and be bullish if they aren't already bullish. So the deeper the bull zone pocket goes over time at a fixed price, it means the bulls are getting stronger. There's more forced hand buying. And on the contrary, you know, on the bear side, if the bear side is sloping up over time, it means there's deeper bears as long as you're in the money as well. Now, either case, the bear zone is arguably, while bouncing all over the place, sloping down-ish over time. Number two is we're out of the money on the bear side, so it doesn't even matter. While the bears are, if the bear side is sloping down, it means there's fewer bears in the money. So basically, as time goes by, shorts are rolling out of their positions and covering. So when they both slope down, the market is ultra bullish. When they both slope up, the little lines here, the market's ultra bearish. So in this case, they're both sloping down through September. And then it gets a little muddy here with no bullishness, no bearishness. So again, the market's going to have to slowly build back a bull position, but it is showing a bull monthly map. As we said back when the market bottomed, we said monthly map's still kind of hanging in there. And then, of course, we've gotten that revert to mean. That's exactly what I was said on the stream. When we at least get a revert to mean trade. And that looks pretty consistent for what you're expecting. So right now, you know, my call is, you know, we're going to fill this gap before we trade lower. That's pretty easy to see. I mean, and obviously, do you guys remember in that? This is what makes rocket scooters so great. Do y'all remember in that first, the first pullback of the Fitch slap and the market's trading down? All the bears are like celebrating. Market's bearish, market's bearish. And yet DD was like 98, 97, 96%. And you guys are like, doesn't make any sense. Market's trading down, but DD is 90%. Is DD wrong? And as I told you guys, just wait. DD is ultimately going to win this fight. And guess what happened? DD ultimately won the fight. The market stopped selling off once that expiration mechanic rolled out. And now we're back to the normal days. Y'all see that? DD doesn't lie. This is actual bullish positioning. So your two major things you look for sentiment is the DD ratio being greater than half just shows that the stocks are stuck in bull zones. When the S&P trading, SPY trading in its above monthly hedge pressure, wherever it is, way down here, 428.5. We're stuck in monthly gamma for the month. So not only do you have long gamma hedging for the course of the month, you have DD ratio being bullish, number two. Number three, monthly maps showing that bull push and that short squeeze. Number three. Number four, VIX decay below triple B. This is all the setup for a clean bull market still. Those four things together all line up completely perfectly. Do y'all see that? The stuff we teach y'all. You take 10 grams of taurine a day. What does taurine do? I know it's in energy drinks, but is it a boost share? What's it do? QQQ from Shiv. Sorry about that. Okay. QQQ is still being steady, and there's support right here for the long side for me thinking on Qs. Honestly, I think the power is going to come in the S&P. I think there's a lot of. I know tech is. Once tech picks up some steam, the S&P is going to go faster, but I think a lot of the other sectors are going to move a little bit quicker. The S&P resilience is clearly better than Nasdaq resilience, right? So when you look at the two, S&P usually wins the fight. It'll drag the Nasdaq along with it. I don't days when Nasdaq is in VWAP middle and close to your difference. You'll sit this one out. Yeah. The S&P is positive and Nasdaq is negative. What's more likely the case is that the S&P pulls the Nasdaq around and not vice versa. It's more diversified. So if there's a tiebreaker between the two, if you're taking notes, always remember that the S&P being more diversified as it represents more sectors. Nasdaq is only really tech, telecom, and healthcare for the most part. Is the highest weight in that. And it's not having energy and financials, utilities. And so being more diversified, the S&P is more of a gauge of the market breadth. And so if the S&P looks great, Nasdaq looks bad, it can just be one sector that's making Nasdaq look bad. And one sector doesn't topple the market, even tech. So the S&P resilience positive and Nasdaq resilience negative. It's just sector cycling. People are probably selling out of tech and rotating into something else. It's pretty normal. Yoga in the morning, at night would be your suggestion. I am a practicing yogi. I love yoga. I've been doing yoga for 11 years now. I haven't been doing yoga much this year because I've been doing like interval training fitness, But my yoga studio I go to does these 40-day yoga challenges, and this is the first year I haven't done it in the 11 years. And they do it twice a year, so you do yoga straight for 40 days every day. Even during COVID, I did it. I did it at home on Zoom. I used to do them religiously. The next one's starting up in the fall, so I'll probably tone back into that one. That's how I got super skinny, like doing vinyasa style hot yoga and fucking workout yoga for 40 straight days, not missing a day. It's good for your blood pressure. Anything past me 2 hours is risky, you guess. So 24 to 60 is a sweet spot for the fast. Okay, I'll try it out. Fried or hard-boiled eggs? These are scrambled eggs. Amazingly delicious scrambled eggs. Made by my own personal chef, who's also dying from the same cold that I have. IWM? Let's take a look. All right. Market looking great. IWM looking great. Let's go ahead and take a look at IWM. Resilience, Russell resilience, still positive. Trading through the gap. Looking great that way. $45.40. You're getting no liquidity maps for stocks. That's weird. We had a new release. So when you have a new release, you need to log out and log back in. And that could be why. We usually log you out on your own. So a lot of people reported that today. So maybe you still have yesterday's session open. So close your platform, open it back up. You should be good. All right, the S&P trading up to a yellow line, 45.27, near target coming up. 45.38 is upper DD band. So we are 13 points away from it. It's looking great. French soft scramble. Oh yeah, dude. These like, yeah, just where you whip them and they're still mushy and you turn the pan off while they're still liquid and then they just harden a little bit. I like them sloppy. Without revealing the secret sauce, how is bull bear zones determined? What's the rationale? Can't tell you. That would tell you how it's determined. That's the secret sauce. Bull zone and bear zone is based on a hedging algorithm that I wrote that assumes certain options, not all options, but certain options are part of a spectrum of risk distribution for just being options that are held by market makers to hedge being in positions against us in the market. Give you a detail. If you go out there and buy 20,000 Tesla YOLO calls, okay, out of the money or whatever, or you go out there and buy 1,000 Tesla shares. This is two different scenarios, A and B. You buy 1,000 Tesla shares, and then a market maker shorted those shares to you, and then they bought 10 calls, okay? Our algorithm is looking for a relationship like this and removing a relationship like this. That's all I'm going to tell you. We filter out the options that we believe don't belong to dealers. You speculating against an option seller. So you have market maker option, okay? You have market maker stock, put an E for equity, and then the trader, which is you. It's a triangle. So you trading against an options dealer, there's no risk there. They will go out there and assign, or they will go out there and chase longs if those calls go in the money. But against you, there's really no balancing act that is a forced hand buying. The risk is very low. You're out of the money. Hopefully we'll ignore this. We look for a trade like this where you're in an active equities trade against a market maker of the equities who buys calls from the market maker of the options. So we're looking for this relationship, two of them. Looking for you engaged with a market maker hedging with options against a dealer. So we're looking for a dealer-dealer connection like this, which this balancing act of this dealer to delta hedge the equities position to neutralize their trade maintains a pressure in the market. And then this options market maker who sold the option to the other market maker, so dealer against dealer, this relationship here is the real battling match that creates zones and hedge pressures. Because if you think about this, a trader bought shares from a dealer of the equities who's also in a shares trade waiting to find a seller to match the buyer. And they bought options to go with it from this guy, market maker option. So if those calls go in the money, this seller of the calls has to long and you long. So you got two people long against the house. But if these calls go out of the money, any longs this person has that sold calls, they're going to sell the rate of delta. You're the original buyer, and if this market maker presses those calls out of the money, it forces that market maker to sell. Seller matches buyer. We're looking for this relationship. There's your secret sauce. The dealer of the equities is forcing the seller of the options to sell shares to match the buyer, the original buyer. And vice versa on the put side. The seller shorts the market maker had to long and buy puts. The put seller will have to long the market if those puts go out of the money if they already had a delta hedged position. So that forced hand dumping of those positions is what we are looking for. You like that? You thought it was just some basic stuff. You forgot that I'm a math nerd. Any more questions? So we try to ignore speculative options that likely have no risk on the table. We're looking for that roundabout looping where movement in price is going to force people to continue buying and selling the shares. So we know that the dealer in the middle is maintaining a balanced position. So every time you make that assumption, price goes up or down, you can always recalculate that rebalance. So in long story short, we have some very clever math that takes that distribution that we find that creates where forced hand buying and forced hand selling is maximized. And there's a kind of a, if you look at it here, like if you were to turn your head on the side, forced hand buying is maximized right there. Forced hand selling is maximized there. So like, it's like this. Like you turn your head on your side, it's like a graph. Like if like look at an axis, the amount of buying and selling. So it's kind of like, imagine like there's just like a spray of air going this way and a spray of air going that way. The further away you are, the velocity of the air is less because the pressure drop is lower per incremental change. So like right at the edge where the pressure is the highest. So we're looking for that discrete pressure split of when that buying switches to selling. And that's what we do. There's math too. So it's like, not only is that relationship important, but it takes very complex mathematics to create that split. So obviously it's very detailed under the hood. Getting no liquidity maps for stocks. Try logging out, logging in should be good. Your first trade using Rocket Scooter platform and futures. Ooh, good luck. For DD, a ban alerts CD to have an open futures chart. Right now, yes. No, I'm sorry. No. You have to have an open futures connection. My bad. If you have futures data, it should power the alerts. You should be good. So we're going to test them out today to see if they work. They're going to match your cheat sheet. So on your cheat sheets, what you'll see is every single time you have DD band breaks, you're going to have it open. When you have DD band break like this, it's gonna look this. It's gonna be red as soon as you break out, yellow if you break back in, and then it's gonna flip between red and yellow for the day once it's broken. So maybe we'll get our first DD band break today. We'll see. You need to add liquidity map indicator. Yeah, you need to add liquidity map to the chart. That would be very helpful to have your liquidity map show up. It should default to being there, but you know what's funny? I've sometimes complained in the development team, like, guys, my liquidity maps are not showing up. And I sent them on a wild goose chase one time, and they looked everywhere. Couldn't figure out why mine wasn't working. And I too had deleted the indicator. And it took us like hours to figure it out and completely waste everybody's time for a day. And so it should load by default. But yeah, if you remove liquidity map, it's not going to show up. And also DD bands are all part of the same liquidity map indicator, which is good and bad. It's good that you don't have to add anything. It should show up automatically. And when you flip between equities and stock, equities and futures, you'll have the different indicators pop up. But also, it's not intuitive that DD band is part of liquidity map. So Microsoft Edge, the move for Rocket Security, it's a huge step in performance. I love Edge, and that's because it, like, I use it for very few things. Rocket Scooter. What is that? You like scrambled eggs are dry? You're doing something wrong. I know. See, Nicole had to teach me how to make sloppy, runny eggs. Do you need market data to view the market data, Hulk Fart? Yes, you do. You have to purchase market data. The way you get it is you connect to Edge Clear. It's $1 a month for the CME exchange. That's it. If you make a futures account, you'll deposit a minimum into your futures account. You don't have to trade with it. They'll just deduct $1 a month for your data feed. So that's basically the life hack to get futures data for you guys. You can trade. I trade with my account. You don't have to, but they will supply futures data to you with an active brokerage account. You've been on a chai tea kick. Nicole likes chai tea. It's good. I like it too. Spy actually might beat DD, BQs to DD today. I believe so. Was that a yellow hit? What's up, James? Yep. That's correct. Good call, man. These are old yellow lines. There's still going to be pivots. These are very old ones. So it's going to be our first kind of pivot. And this one was actually created from the big downside. The dash ones are downsides. This one came from... Where did this one come from? Hold on. Oh, yeah. So this one right here is actually... It comes from the first sell-off. So actually, back in the day, the very first sell-off that we had in December or January, that very first sell line is 45.27. I think that's the one we're touching. Yeah. So it's still these open impact lines over here. So that this guy is still sitting there. Good call. Nice eye, by the way. Seeing that. Again, you can just see how long those pivots last. There's always selling pressure at them. So obviously be looking to recapture it. This is the power of the yellow line calculation that we have. And I can't wait to automate this in the platform. There's always, you see how when you get close to it, there's always interaction points to it. And this has to do with those original shorts and the new longs smashed into each other here. It's a liquidity point, right? Or illiquidity point, where a bullish run and a bearish run meet each other. So you have basically like open short positions, open long positions, kind of at a nexus, and both of them are in the money. So it's like, it's not necessarily liquidity because it's not forcing people to like buy or sell, but you have two winning traders pitted against each other. And it's a possibility that, you know, one of them is going to close to just take profit. No bull or bear zones above where Tesla is currently sitting. Does that mean we're likely at the peak of the day? No. Usually means, depending on what the liquidity map says, you're probably very bullish. Let's see what it says. So yeah, in this case, anytime you're trading above a bull zone, it's still bullish. It's not just not identifying It's not identifying any kind of like additional, bull power, but by deduction, the algorithm still calls it a bull zone, as you see. So the way that it works is anything above a bull zone is bullish, with nothing above it. Anything below a bear zone with nothing below it is also considered bearish. So while this falls outside the threshold of the distribution, there's still calls in this range. It's just not what our algorithm discovers as being dealer calls. See how, what's neat about Rocket Scooter is this pure distribution. You know how clean this is? There's the bears and here's the bulls. This is what makes our stuff very powerful. It's not choppy. It's not noisy. You guys go look at Max Payne and things like that. It's really noisy, right? You guys ever seen a Max Payne chart? Look at this. This is what Max Payne is, right? Imagine that if you turn this on your side, turn this on your head to the side, and this is what your bull and bear zones look like. Bull, bear, bull, bear, bull, bear, bull, bear. Imagine how horrible that is, right? So Rocket Scooter is what Max Payne wants to be when it grows up. Look, there's one side that's bulls, one side that's bears. Nice, clean, two distributions. So mathematically, we're superior to the traditional method of analyzing options. The Max Paynes of the world, the GEX of the world, the Spot Gammas of the world, great technologies, nothing against them. Love all those guys. But we're clearly the next level of that. Those are the giant's shoulders that we stood on to invent our tools, which is the market maker distribution. If you look at all open interest in the market, it's not going to give you useful information at all. 45.27. Look, that's trading right here. I think this is today. I don't know if that is grade 830. So what's going on? Is that support? Is that resistance? Max Payne is a very weird it's very bad for being actionable. It really doesn't tell you much. It just tells you where open interest is, but not. So if there's 10,000 contracts at 45.20 and 10,000 contracts at 45.30, what's more important? You may say 45.20, but if those 45.20s were bought by somebody at the wrong time versus the 45.30s, they may actually be worse. And it depends on when they were bought and the risk that goes with them. And so not open interest alone, that's the key to what we do. Open interest is practically useless. And that's where a lot of the option services just look at open interest and heat maps. And I know a lot of people get really kind of nosedivey into that information, kind of like you would with technical analysis, and you're sitting there staring at noise trying to derive logic. We always have to tell people that, you can endlessly stare at noise and try to find an answer. And I always remind people that John Nash, the famous mathematician, right, the Nash equilibrium guy, beautiful mind, he drove himself crazy trying to derive algorithms from noise. He would, there's a famous scene in the movie where he was watching pigeons on the ground. He threw a thing of breadcrumbs down, and he was trying to find an algorithm that describes the competition and behaviors of pigeons fighting over bread. Just staring at pigeons eating breadcrumbs and trying to jot math out of it. Kind of go a little crazy digging through noise of that magnitude. Now, he was searching for his equilibrium model, which is a little less chaotic than random Brownian motion of pigeons. But when you look at negotiation between two people, not between hundreds of people, you really get some good information. So I always say that whenever you're looking at open interest heat maps and things like that, you're essentially staring at pigeons fighting over breadcrumbs. You're not going to really derive any useful information from that at all. Edge turns RS into application. Is that a goal eventually? What'd you say? Edge, what is Edge? Oh, Edge turns RS into an application. Is that a goal eventually for Rocket Scooter to be its own app? From a programmer's sense, I have no idea what you're trying to ask me. Are you talking about a mobile app? An app in an app store? An app in the Microsoft store? It is an app right now. It's a web app that loads in a browser. So just like Spotify is a web app that opens in a browser. So do you mean, is it going to be in a mobile app store? Is it going to be a mobile app? because it already is a web app. That's what you're asking. What is yellow line on the risk interval tab? You have to watch the yellow line video. This is how you calculate the yellow lines. This is illiquidity pivots. That's the ones we're talking about today. See these yellow lines on my chart? See how there's a pivot there? The yellow line is a process, and the videos and the tutorials in the Discord will show you how to calculate them. I have a whole array of yellow lines. They have to do with illiquidity pivots. They're longer term pivots on the S&P. And these little boxes are old measurements of them. But essentially, every time you touch yellow lines, the market pivots very drastically. It's a great tool. I'm going to show you something cool. So these are old yellow lines here. And whenever like market breaks out to a high, you can calculate where a pivot's going to be. And it's hard to see on these daily charts. It's much easier to see on like a intraday chart where you can see some of the action. Now, again, we're outside of the realm of where you can see the coolness of it. But I'll just give you some examples of past ones. You see where my mouse is right here? Like the market rallies here, we calculated a yellow line. Now, it's since been eradicated, I think. Let me double check that one's gone. Yeah, that one's since been gone. But there's an example here. Like, you can calculate a red line, which is one of it's called illiquidity pivot. So these guys right here and these guys go in tandem. If you calculate a red line, you can extend to a yellow line. It's a futures thing. It's one of our best tricks. And you see right here, as futures are trading higher, the first major pivot comes off of an exact bounce off of a yellow line. These pivots are high volume, predictable high volume pivots. What even makes them cooler is that when you're trading the all-time highs, yellow lines forecast highs out of bounds of where you've been trading. So an example is like, it's kind of, you can see, it's hard to see where the pivots are because it's locked in the daily candle. But if I were to, let me see if I can't find the tutorial that I made on that. I think our sum only goes back a year on the hourly charts, which sucks. So I can't show you guys some cool examples of that. Let me pull up the handbook and show you. Here's just a picture from the Discord. So like from this particular day, when the market rallies and breaks out, I can draw a distance. Yellow line is that distance of how you draw from your anchor point. And I measure this here. And so like this is one that was measured from here. This is one that's measured from here. And you can see that the first thing you do is when you get to this, there's your resistance that comes from it. You see that? So it's like a target. When you're trading day to day, you're trading to DD bands as a target, but sometimes it happens if you break outside of DD bands. Might be hard to see this, but the market broke out of DD bands and hit that yellow line, and then that was the pivot for the next day. So anytime you're trading outside of DD bands, you need some illiquid pivots to go off of. These red and yellow lines are perfect. Even on the downside, I know like some of these days you trade outside of DD bands, this yellow line was support. And it's one of the best pivoting tools that we do have. It's not automated yet, but of course it'll be automated in Pro Plus. Like I said, Pro Plus deal now is $139 a month. When yellow lines and red lines come out and automated and you're not in Pro Plus, it is $200 a month and eventually will be $300 a month. I know you guys liked having your $35 trial or your $100 a month Pro Plus or whatever, but it is now $139 unless you upgraded this week. When yellow line and red lines come out, it's going to be $200. So keep in mind, those of you that want to sign up, you got to sign up for the prices go up. So by the end of the year, Pro Plus will be $200 a month. Mark my words. We'll automate all that. And we're making AI assist. Now, we're going to shift the packages around a little bit, but AI assist, rule assist, these are going to be the next biggest things we're going to have. Where like, if you're breaking rules, the platform will talk to you about the rules you've broken. Like if you're trading after 2 and you have a rule that says don't trade after 2, pop-up will come up and talk to you about, you know, like, hey, by the way, you're breaking your own rule. Are you sure you want to make this trade? Things like that. They're going to be very awesome. The feline risk manager wants to chat. Literally crawled up here to lay by my breakfast and then just stare at me while I'm trading. Oh my goodness. So I know everything's changing so fast in Rockscrew, but we're glad you guys are here supporting us and supporting what we're building. The more stuff we make, obviously, the more prices will eventually go up. But we tell people is that we reward those who get in early, just like in trading. If you're in earlier, you get the better deal. Down the road, we're going to try to have more broker connections. We're going to do all kind of neat stuff. All right. Market's still looking clean. Or maybe another wave up. The yellow line could be resistance. We'll see. Either way, it's a decent place to watch markets. All resiliences are positive still. Yeah, that's what I said, Robert. The plan to automate drawing of yellow and red line will be a future project for sure. It's a more complicated task, but it is definitely in the Pro Plus package. Automated catalyst, automated yellow line, red line, DD bands like we have, DD band alerts, VIX risk interval alert, yellow line, red line, automation, all of that is going to be part of the Pro Plus package. Every like you buy it, put Pyre becomes homeless. Let's go, let's go. Yep. So those yellow line and red line numbers update every day, by the way. So in the risk intervals, you have to change. You got to be aware of them every day. And just letting you guys know, we want you to support the platform. I know I'm showing futures for this week. After this week, I'm no longer going to be showing futures indicator on my chart. I'm not going to be showing DD bands because it's part of the Pro Plus package, and the stream is clearly going to just hand that out to everybody. So remember, after this week, no more showing DD bands on my screen. Look at this cat. What he's doing. Yeah, he definitely looks drunk. Hold on, I'm gonna mute my mic. Yeah. Right. All right, so guys, check this out. Remember I said this morning, anytime VIX hits, and I don't know if you missed this one, but anytime you hit a possible volatility pivot in VIX, for instance, VIX hits hedge pressure and starts going up, volatility means the market can start increasing in volatility. So while it is still showing bullish signs, things are looking somewhat okay. This is a nice little dip if one were to buy, to probably add a little bit more to bet the VIX trades lower. Now again, that support on VIX is that expansion of volatility. You see how the V's got slightly bigger? More complex topic, but that's why we keep VIX like on the back end of what we're looking at. Because anytime you're trading up and VIX hits a pivot, and you can forecast volatility is going to increase. Always a good time to take some profit. Nope, DD bands are futures price at 5 p.m. or 6 p.m. Eastern. At the futures open. So since DD band is a futures thing, if you guys go to the cheat sheet, I always tell everybody, these cheat sheets give you all the answers. We made those to make it very simple. The cheat sheet will show you how to draw these things. Let me give it to you real quick. All the relevant data is here, my friend. You go here, look. It is the 5 p.m. close, one risk interval lower, one risk interval higher, and then it lasts until 5 p.m. close. Got it? Cool beans. Okay, yeah, no problem. Yeah, so what we're going to do is see what happens if we interact with hedge pressure. Keep an eye on resilience today. Resilience is still positive in the S&P. A little bit of selling pressure. The market's going to try. We have a impact red line, run linked red lines here to take a look at. There's two from yesterday on the S&P. There's one from NASDAQ. So the question is, do we stay inside of here and continue to move higher? Obviously, there are people going to still be trying to sell this. This red line holds open for the rest of the day. That's a great sign going forward. So probably today adding two positions around hedge pressure wouldn't be a terrible idea. But I don't like when markets do something like this and you all the way down. So I might be very careful. Only long off a pivot and hedge pressure. So does everybody see how the VIX is an important key feature? Is like whenever you're trading for an exit target, anytime you can predict the volatility is going to change. For instance, bouncing out hedge pressure is a time to take profits on a long. I think I should actually make that. It's not really an official rule in the exit targets, but I'm actually going to put it in there today because it's a great example of it. Anytime that you can predict that volatility can pivot, that's the rule. Okay. Is that if you're in a winning trade, that's time to take profit. It's not time to enter a trade, but it's time to get out and take some profit. So an example is here. Let me make this. Y'all see that? And this is generally a rule of thumb. Like the UVXY bull zone bottom has the same effect. But anytime you can anticipate VIX can pivot, you see that the market suddenly becomes more volatile, right? Mm-hmm. 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 Yes. See how that works? And that's just something to take note of. If you can anticipate volatility is going to be there, you don't want to just hold and burn through it, right? The volatility goes up. So here's your volatility, right? Volatility. So you draw a little bit better. V, 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 V. Volatility. You can predict volatility, it'll go up, then you can predict the downside pivot in your trade. That's another thing. And it means you have to watch VIX. That's why I keep VIX on one of the charts. Just to make sure there's nothing in the way. It's just like a key to make sure you can take some profit on the way up. So like right here, exit, right? Exit. Because UVXY tap hedge pressure. And you don't know if it can bounce or break, because remember, bounces are more likely than breaks. So we take the more likely case that the bounce will happen, the market spontaneously becomes more volatile. UVXY tapped hedge pressure. Okay. So this is another, I'll put this in the exit rules because I'll make this 6 out of 6. Not yet. Oh, I'm not looking at it, my bad. Yes. I'm looking at the chart here. Okay, wait, resilience is negative, so let's keep in mind right here. Good risk and reward on this will be making sure that 10 points below hedge pressure, 448 is a sell-off target. VIX is at half cap. Okay, so we're 19 total. Okay. All right. So, VIX predicting volatility. Okay, predicting. Okay, and we'll do it just like this. Okay. Let's see how that works. Anytime that you can predict, anytime you're in a winning trade and you can predict increases in volatility, like hedge pressure or MHP tap or bull zone bounce, it's a good time to prematurely take profit on index trades because volatility will interrupt a straight line rally. For example, as shown below, and introduce some waves, maybe second lows to get in on for a second trade, etc., but at least close out on the first trade as an exit target rule of thumb. You guys got that? Can I explain how to place them? There's a video that explains how to place them in the Discord. It's about maybe a 20-minute video. So watch that today, Wisdom. It's a good video. Okay, so right now we need to be watching resilience. It needs to go above 0. It's not above 0 right now. You need it to go above 0. Oh, yeah. Yeah. Okay. We need resilience to go above 0 for the market to stabilize here. This is a nice little scalp to So decent technique right now. Everybody pay attention on my screen really quick. My student just executed their first scalp. So essentially in a long position, a medium long position, and was not around to exit. This is the rule I was talking about. And so as we were making breakfast, didn't see this. So what happens if you're in a long scalp and you're just trading for the day? It fell to hedge pressure. What she did was she doubled down on her position. And then right when we went through to the upper side of the resilience band, just to get a scalp that's probably very easy to see, right? Everybody knows hedge pressure is a decent support, bull long up. And with resilience being negative, the minute we cross the other side of the box, she trimmed out on what she added, and she's back to original position. What that's called is cost basis management. So what she did was she now lowered her cost basis on the trade, which originally was probably somewhere like here. Now the cost basis is 4506. Okay. So what she just did is she cycled her position. She was long here, 45.14 give or take. Market fell. She doubled down here, and then she closed out what she doubled down on, and she's in her original position, and now her cost basis has gone from here to here. Cost basis management. See how that works? Cost basis management. So what she did was she took a predictable pivot, which is a hedge pressure bounce, was looking at it to say, let me take a scalp, risk to reward, at least 10-point loss, and I'll take a retracement trade with the added bonus, okay? And then when we traded to the upper end of the redistribution zone, resilience is not necessarily super positive. It's barely hugging 0. So she just trimmed out what she added in and basically cycled her original position to back down to a lower cost basis. You'll see how that works? Yeah, she did write it down from the entire time, but that's because she had to disappear for breakfast related reasons. And we're still, one of the things with a budding day trading student is learning the timing of being able to watch while you do other stuff. So this is my bad, but I did have some delicious breakfast. And as it was falling, I just instructed her just to wait till you had hedge pressure. So I didn't hold it all the way down, but it got to here. I said, because we missed this. I wasn't able to catch that, but I'm multitasking like 25 different things. So it's like, what do we do? What do we do? I said, it's okay. Double down here. As soon as you pass through redistribution zone, close out, and now you have a lower cost basis. And now that trade will take off for the rest of the day. I sent her on an errand and she wasn't here. It was my bad. Resilience is not negative. It's just hugging 0 right now. It was negative for a little tiny bit, which is why this hedge pressure bounce was enough to take some profit on. We don't expect it to bounce and keep rallying really hard. It's going to bounce around hedge pressure for a while. So now we're going to probably wait 30 minutes to an hour to see if it actually holds hedge pressure. But this tiny little scalp is the way to lower the cost basis. And now your trade should, I'm not even looking. Is your trade in the green for the day? Yeah. So you see how this trick has now made you green for the day at this current spot, which is actually lower than what you originally bought. What you originally bought at was slightly higher, right? Right here. Right here. You usually bought like right up here. So now the market's trading lower than where you bought, but yet you're green. You see how that works? Teaching scalping is really hard. She's learning day trading, which is hard enough. But this is scalping. So do you see what scalping is, right? Scalping is taking multiple trades throughout the day to either A, take advantage of multiple opportunities, or B, to lower your cost basis by manipulating your position. A pro day trader is a master scalper. What we just did today right here, the difference between us and you is probably that. This technique of knowing, okay, should I double down or should I close out, is the art of a masterful day trader. Knowing that the market's going to bounce at hedge pressure with high probability, but it's not going to bounce and rally because resilience isn't strong enough. So it was like, I think I have position sizing class, but this is that's a very important lesson, is that if markets go against you, you don't freak out and you say, okay, what do I need to look for? Where's my next pivot? Where's my next bounce? And while she did have a little bit of profit on a small position, essentially went very, very, very little under, because she didn't long very heavily because we were waiting for hedge pressure to tap. And once hedge pressure tapped, we dove in pretty heavy and then we trimmed out pretty quick. So we're in that long for probably, what, 3 or 4 minutes, and then closed it out, lowered the cost basis. Now her cost basis is right up against hedge pressure, which is beautiful. Imagine right now, at the start of the day, look at my screen real quick. So right here, you started out here. Hedge pressure is right there. You actually are in the green trading lower, and your cost basis for a long entry is literally right at hedge pressure. So what you did was just shifted your cost basis lower, and now you have a really strong trade setup. You have a better trade setup than you did this morning with the same position size. See that? You actually you forcibly gave yourself a small loss is exactly what you did. So that's exactly right. She noticed FIFO, first in, first out. So technically what she did was close out relatively flat on the initial position. So here's what you did, babe, right here. Say that you bought, like an example, say that you bought 5 here, and then the market dipped to here and you bought 5 more. And then you close out those 5 right here. You basically were flat on your original trade. Yeah, you're correct. It's FIFO, first in, first out. But now you're betting on your second trade being the winning trade, which, how much are you up right now? 200 for the day? Pretty good. So now what you are is where you originally entered earlier today, you were flat at the same price. Now you're up 200 at the same price. So anytime you can lower your cost basis opportunistically is a masterful style for a day trader. Or close on break even, which is one of the things that we normally, and one of the students here is telling you the same thing. Why didn't you stop and take a loss? There was negative resilience, you would close at break even. And normally we would close at break even. Usually when it dips, you double in, and once you break even, close out. It's a quickie scalp trick, but resilience is decent enough for us to say maybe. Now resilience is going negative, and I'm not liking the support here. So the question is, you need to make a judgment call. Do you want to take your 200 and walk, or do you want to keep going? Do we think the market's going to rally from here, or do we think it's going to still be bouncy bounce? What do you guys think? Y'all take a vote today. Resilience is not necessarily, it's hugging 0, it's -3. So it's a judgment call. It's not very bullish right now. It's probably going to dip a little bit more. So it's up to the trader to decide how long do you want to commit to this trade. If you want this trade to play out, you're probably stuck to it for half the day. Or do you want to take your 200 and call it a day? Or you can trim it down and let the half of the position ride if you still believe in it. Resilience is your only key indicator right now that the market's likely not going to bust a big fat rally from right now. You're wanting it to go positive to give some strength on that support of the upper box. With the resilience being negative, it indicates that there's likely another downside wave from here. So what one can do is trim the position even further to half again if at some point you feel uncomfortable with resilience not giving you that sign. And a lot of times, as the students are reminding you, if you can break even with a little bit of profit, then that's always a good sign. Right now, I would say, if it were up to me, I would close out and start taking some profit. Just I would hold a little tiny bit, like maybe 5 or 6. Miro said they would go flat. Yeah. And is, again, you're watching resilience try to deteriorate. It's slightly below 0. It's not grossly below 0, but it is below 0. It's worth taking note of. So what it does mean is, let's forecast the rest of the day. Let me show you on the screen really quick. What's likely to happen is that this is going to probably test half gap one more time. And then from here, it's probably going to fight its way lower. If resilience goes negative, then, you know, we're going to be down here. Hedge pusher break would be rare, so I'm not going to bet on that. But it might take all day for the market to rebuild a long position of that magnitude. So it might be all the way till the end of the day to get the run. Now, if you're very bullish on the longer haul, one may hold through this just using plain risk and reward. 449 is your entry. 448 is your stop, and then let it ride. Risk and reward is great from here. If you're planning on an end of the day run, 30 points from here on a 10-point loss isn't a bad idea. So one may hold through it, which is also an option. But always know, if you hold through it, you are committed for the most part for the majority of the day, 2 or 3 hours at least. Yeah. Yeah, data burn, exactly. Great setup day today. Yeah, honestly, I'm still in the belief system that we still rally. Shine bright like a diamond. I don't agree with the wisdom of never add to losing position. That's not wisdom. That's stupidity. Who says that? That is absolutely stupidity. That's not wisdom. The entire stock market is framed on the concept of adding to losing position. Look at the asset managers. Watch this. Let me go back. Let me show you this. Not that what you said is stupid, but that wisdom is dumb. It's not a losing position. It's just a winning position that hasn't won yet. It's a lower cost basis. If you add to like a bag hold position that's doomed, yes. But the philosophy of people buying as markets dip. Cost basis averaging is actually the complete basis of how asset management works. Your hedge funds or asset management pools are stupid. They throw money as markets dip. Look at this. Watch this. Here's the 2008 crash, right? Markets are selling off and selling off and selling off, and yet the long position, this green line, is becoming more and more and more and more and more long. And then finally, after the market crashed, look what happened. The only time the market actually like dipped down was between here and here. That's the only time they liquidated their position. And then during the recession, the lower markets went, look what they did, adding to their losing position, adding to their losing position, adding to losing position. Cost-based management is how your retirement account has more money at the end of your lifespan than you put in. We're releasing the new face of the platform, and they're releasing it in steps instead of all at once, just for stability. They didn't tell me they were releasing the piece of it today, or else I would have told you guys about it. It surprised me too. And I was like, what's going on? Did y'all release pieces of the new font, the new platform? Yeah. So the platform is going to get a whole new look and feel to it. So you're going to wake up every day. It's going to look slightly different. It'll be all in the same place, just like fonts, colors, shape, sizes will look a little different. Yeah. You have to manage your position as a trader. So whoever teaches things like if you don't add to a losing position, it's not a losing position until hedge pressure is broken. Then it's a losing position. This is just a winning position with a better entry point. So like I know people say like don't add the losers. Those like probably AMD traders, right? I mean AMC traders. No offense to them if you're in that boat. If you participate in the biggest trading scam in history and you bought AMC stock, you got bamboozled by Michael Burry and all the other smart people out there who convinced you that a congregating movie theater place with sticky floors is a place to go during a pandemic to watch movies in the era of streaming services when you can do it from your couch at home safely, avoiding very nasty, silly COVID. But they convinced you in 2020 that a movie theater company was going to be all the rage. And people thought that was it, and they bought it 700, 650, and then they literally added and added and added and added, and it's back to being a penny stock almost. And even here, for an entire year, people were hoping it was going to rally again, and it's going lower. So, like, this to me, I can't wait for the documentary to come out. That one trader goes, this is how I did it. Like, the reveal on his deathbed. Here's how I wrote a bunch of bots to create social media hype around a completely stupid concept like flat earth and got everyone to believe it. And then they believed it. I made billions of dollars, and sucks to be all of you, but here you go. This is adding to a losing position. Not only is it a losing position technically, but it's a losing position fundamentally. It's a goddamn movie theater in fucking global pandemic. You are an idiot if you bought this stock. No offense if it's any of you. I mean, you can stream movies from home. And GameStop, nobody buys video games anymore. GameStop sells teddy bears and t-shirts. Love God. So anyways, I have to say it for your own good. I love you if I called you an idiot. But seriously, hype, if you ride the hype and make money, that's one thing. But if you're holding something for fundamental reasons, which is what people are doing, then that's where you don't add to a losing position. Because what that does, it keeps you giving yourself confirmation bias. You will ignore what's in front of your face and keep adding to a loser with better hope that you're going to come out of it alive. And you're ignoring the writing on the wall. Is that asking me to hold AMC stocks? How many times do you go to the movies this year? Well, only a couple times. Well, I mean, it's like, you got to think about it. It's a dying institution. GameStop was a dying institution since 2015 when Xbox released the marketplace and you can download video games from the marketplace. The minute that happened, the minute Xbox One came out, GameStop trended down forever until this last thing happened. Y'all remember? Let me open up here. I remember making that, having that conversation on my stream back in the day. Right here. When the Xbox One came out, November 2013. Xbox One release date, November 2013. Here you go. Here's November of 2013, guys. Right here. And the Xbox and GameStop never recovered in the era of digital media until somebody wrote a bunch of bots that convinced social media it was a worthwhile investment. Right? And again, it's slated to go back to being a penny stock as well. This is real fundamentals. I mean, this is literally, this is Christmas season. Look at November. This is the launch date. Literally the launch date, November of 2013. You'll see how this works? The minute you can download your video games from your console, you're not going and lining up outside of... Now, I miss the days of lining up outside of GameStop at midnight to buy like Halo 3 where I got the Master Chief helmet to hold my games. Oh, I miss those days, right? We can get all your exclusive content. Going and pre-ordering your game at a GameStop. And then when this happened, that part of our life ended forever. Now nobody buys games anymore from GameStop. So it's kind of like the idea that when CDs come out, you're not going to... This is the equivalent of like when CDs come out. You're out there buying VHS tapes like they're going to make a resurgence. So anyways, that's what a loser you don't hold on to. Something that's fundamentally dead because of confirmation bias. And that's the sticky part. I want everybody to take away from this conversation. It's not that you don't add to a loser. If you know it's a loser, don't add to it. But if it's just a late winner, your loser has to have a meaning for a loss, right? So what do we know as a loss is when you lose hedge pressure on a bull long up. That's definitely a loss. Now you can use resilience to maybe gauge if the market's going to sell off faster or not rally faster and maybe close early for profit, which is like right now. It's not terrible, but it's not the best when we want to see it better. You have to determine, is it a loser? Well, the resilience is only going to pivot us down here again. It's not necessarily going to imply a hedge pressure break. So the way I define a loser today is if we're below hedge pressure, and that's it. Yeah. So even if you long and you're in a loss, it doesn't mean you're in a losing trade. Your bad entry doesn't make the trade a loss. It makes you in a position of, puts you in a position of losing money, but your trade is not a loss. You have to have the capital cost average in. So would agree it's a losing position when the P&L is red? No, that's not a losing position. You're a losing trader. The position, your bad entry doesn't change the way the market's going to behave. If you entered at a bad place, your inefficient trade does not change the stock market. If you longed at the top and you're in a loser, it doesn't mean you shouldn't long here because you've made a terrible first decision. Make a better second decision. You're thinking way too much into it, Ralph. If you make a shitty trade because you're a shitty trader, that doesn't change that you should make a better trade at a better place. That's the whole point. And when somebody says there's wisdom, wisdom would be something that would be a wise thing to do. The wisdom is to not enter in a bad place to begin with. The actual smart thing to do is effective cost basis management. My student did everything right today. Imagine the max position size of 20 micros. And because we weren't at hedge pressure, the initial position size was half 9. Waiting for hedge pressure to double down on. So at the open, if we're going to tap hedge pressure, would have added 9 anyways, right? And so just because you accidentally fall asleep, you come back and say, oh crap, I missed something. But here's my initial second entry anyways. Double down there again, close out what you added in on, and now you have your original position at a lower cost basis. That is actually the correct way to day trade. To know where your point of no return is, whether you're losing or winning, it doesn't matter. The trade is losing right here, and that's where you need to bail. You being red because you entered at a stupid spot doesn't mean you shouldn't enter at the right spot. Actually, the deeper your loss is, the easier it is to recover easily. Sounds like your sister, Ralph. I wouldn't argue with what I'm saying, dude. Cost basis management is the exact reason market money managers make money in markets. It's not a loser. A loser is a hedge pressure break, and I'm not going to say that again. You're wasting my time. That's the loser. If you made a trade at a bad spot, you're the loser, not your trade. You did the wrong thing, so do the right thing. The trade is only the loser here. your position being the loser doesn't mean you shouldn't be in all the way. And the other trick is, if our max position was 20 and we're in at 9, the professional thing is she left herself flex room to be able to do that. You're not all in long. If you're all in long and you're taking a loss, you have no flexibility to move. The idea that you went in half, you have the other half to play with, means you did everything right, other than disappearing for a little bit. But that's okay, because I actually didn't teach her that trick, the UVXY thing. So, you know, anytime you can predict volatility is going to go up, you need to take profit on your long. That's always a rule. But you have to determine the difference between you being the loser and the thing you're trading being at a loss. If you get at a bad entry point, you're the loser. Not like a loser as a person, but the loser in the equation. The trade itself doesn't lose until hedge pressure is broken. You just get a better entry. You said the wisdom of adding to a losing position, and I disagree with that. That's not wisdom. That is complete stupidity to believe that. And I proved to you that your 401k operates under the exact philosophy of here's their money management strategy. Buy as the market dips. Look at this. There are 500,000 net long contracts at the peak of 2007. After almost a year later, 800,000, 60% more long, adding to loser. So when you say wisdom, I don't know whose wisdom or what guru bamboozled you for your money to sell you that garbage, but the entire baseline of Wall Street is adding to losers. That's what they do. They literally, as long as you're employed and throwing money in your 401k, they're buying stocks at a better price as it goes lower and lower and lower. It's not exactly, so when people say that that's wisdom, I say that that's guru baloney. People add to losers by bag holding, which is why I brought up the AMC idea, is that's holding on to a loser because it's a losing company. It, by fundamental reason, is a loss. You entering at a bad spot and your trade being red is not a losing trade. You're a loser trader. You're the reason that it's red, not the trade. So you can add to your red positions. You should phrase things a little better. Should you add to red positions? Yes, as long as the trade itself is not at a loss. I do every day. That's the difference between a winning and losing trader. Effectively knowing when to do that and when to cut and run. Make no mistake about it. I don't trade with a 70+% win rate by doing anything other than that. I make sure I know when I can add and when I can cut. That's the whole goal. You guys all understand that? It's not a loss of your positional loss or your monetary loss has nothing to do with the trade. That has to do with your ability as a trader. So just because you're red doesn't mean you shouldn't add to a position. Yeah, now it's going up. See, now resilience is positive. Now you're in a good spot. Yeah, it's looking pretty good. The edge funds don't have the edge, dude. I don't know. I quit while you're ahead, dude. Just learned something today. This was a professional lesson on how to day trade. I'm very proud of my student. Even recovering from a mistake, did really well. Yeah. Yeah, you're doing all right. There's nothing unprofessional. What is this, a fucking bakery? This is Wall Street. Wall Street is not like, hey, good morning. Wall Street's like, hey, fuck your mother. Fuck your mother. Yeah, fuck you too. Yeah, you need some tough skin, my friend. In Wall Street, you learn. This is not a place where you walk in and just hunky dory, be friendly with everybody is a shark here to take your money. You got to keep your mindset and that ability that modalities and formalities of niceties don't apply in a world where I I've known people who've lost every penny of their own in trading and put a gun in their mouth and blew their head off. So this is not a place where you care about people's feelings, Gary. Just unprofessional would be to turn a blind eye to the realities of what fiercities and intensity of this type of job actually is all about. You gotta have some thick skin, brother. You have to rough people up. Ralph loves me. I know I love Ralph. We're friends. You gotta be rough and keep people on edge. You gotta keep people to that thing. Trading's not gonna be like one of those easy things where, you know, you gotta learn. Like people say sometimes when I say, you know, the market doesn't care, market will chew you up and spit you out. The realities of it is we gotta keep you prepared for that, because a lot of times people get in a trade and they're losing a trade. They'll send me a message like, hey, you know, what's going on? I'm in a trade. I'm at a loss. Can you help me? And I'm like, I can't help you. We're like, well, I pay for your service. And I'm like, see, if I don't continue to keep that impression up, people think that I'm their savior. And the reality is very quick. And the reality is this, like, I'm in it to make money for myself. And that's the reality of trading. And if it comes down, and I love you guys, but if it comes down to it being me or you, no offense, but I got bills to pay also. I'm going to think I want to win my trades before I stop my trade to do anything else. And that's what trading is about. Like, while we do teach and educate you, we teach and educate you. The core principle is that you are on your own. You need thick skin when you do this. You got to be tough. We toughen you up like the military. Want to block your head off after losing $1,000. I know it's tough. Like, it gets really hard for some people. You close everything? Oh, hell yes. You're good. You're good. It's time. It's a whole all-day trade. Wait, good job. Good job. Nice job. Yeah. And I'm actually the nicest person in the world when it comes to trading, though, as a coach. It's like the military, right? Your drill instructor is going to seem like with the guy from Full Metal Jacket. Get on the ground, maggots. Do me 20 push-ups. You know, he's not a mean guy. He's just preparing you for combat, where if you go out there and your hands are shaking, you piss your pants while people are shooting at you, you're going to die, and people around you are going to die. You got to toughen you up for the job you're about to do. You got to bring it back, baby. Oh yeah, I'm going to do the trading challenge probably starting like next week or two. So we have to be very clear, and we have to tell you, you know, what to expect I'm not going to deliver it in a bunny ski slope sort of format. You're on double black diamonds today, and it's to save your own life. And if you don't see that, you should probably quit trading now. All right, I give Matt arguments because I know he can take it. Ralph and I are buddies, and he doesn't. I don't mean any offense by shooting the shit. All right, see you later, bud. We do maintain that intensity because that's really where you have to be. But you have promise for your own good. I do have a friend that killed themselves because of trading. You come in here naive, you get in a place that you can't recover from spiritually and mentally. It's bad news. And we make sure everyone knows that. And that's why we have squeaky clean, you know, like our customers are very much happy with our product and what we do, because we give you that reality. We don't promise you Lamborghinis. We don't promise you simple, easy gains. We really give you the reality of what it is. And we have to make sure that you understand. Wall Street's a bunch of shitheads and degens. You're not hanging out with academia and professors, right? If you tell them be professional, they'll laugh at you and be like, bro, you know, once you go down the job, my sister's hiring at a flower shop. You know what I mean? But seriously though, y'all gotta be very tough to be here. And we're not really insulting anybody. We're just fucking with each other. But if you guys don't let me do my normal nerdy math talk all day long, you gotta understand that it shouldn't give you the impression of safety. Like, okay, we know everything here, we know all these things, and okay, we have this edge in the market. Not a time to let your guard down. Resilience is just kind of fighting for positivity. It's kind of on the fence at 0. No irrational signals yet, so we're still sitting at 0. It looks good. Like, I like where it is. But it's not really bullish enough to create a big, strong bull wave to the upside just yet. It's, like I said, this kind of trade is going to take all day. Actually, my student, once it retraced half the distance, just closed everything out. And took a pretty decent win. So bought again, trimmed out, trimmed the rest, called it a day. And that's a very well executed scalp trade. But like I said, you guys have to remember that, like I said earlier, adding to a loser, there's a difference between the trade being the loser and you being the loser, not you loser as a person. I think that's what he heard. When I say you the loser, meaning your action is the loss. Like, you entering at the wrong spot is the loss. The market isn't at a loss until you break your key fundamental level. So you may be red, but your trade is still winning, or potentially can win. So the difference between you being the loser and your trade being the loser, you being the loser is your entry point was not the best. And so cost basis management tells you to recover you being the losing part of the equation rather than your trade losing a key level. So if your trade loses a key level, yeah, don't add to a losing trade. But you can add to a losing position because the position is based on when you entered. A losing trade is that you're longing below hedge pressure if it breaks the downside. That's a losing trade. Don't do that. If you're losing because you entered at the wrong spot and you still hit your support, you can always add to your loss, but the trade isn't at a loss. You're at the loss. You're the loser. That's what I meant. Yeah, we're gonna have steaks and beers when he comes to Houston for sure. Resilience is lagging, and it's not really lagging. It's just bouncing around. It's kind of sitting at the fence. We just had a big rally day. The market's trying to digest that. VIX is still in decay. You had volatility intervene right on this VIX tap at 15.25, bottom left of my screen, and so that's going to create some volatility in the market that just decayed. You see how volatility got very wide and then started decaying again. Now the market's going to decide a direction. Anytime you have volatility changes, this is what you have to see. So anytime you can predict VIX is going to go higher, it's a volatility change. So that V got really big. Now it's really small again. Once volatility dies out, the market's going to pick a direction and finally start to move. And so the question is, how this results is a bull market. You're going to want to see VIX break hedge pressure and it'll cleanly go higher. If VIX starts to maintain like higherness here, then you're going to still chop for the rest of the day and probably have other waves if VIX stays up in here. So this is that case. If VIX gets to be down in here, volatility gets heightened and it'll speed up. So you have to think of it like that. But I always tell people, like, the conventional wisdom of don't add to a loser is like guru BS. Like, that's such a weak definition of what does it even mean. That what they mean is like don't add to a red position, but that's what I'm saying. That's if you had a bad entry, why not enter at the good spot? Like if you longed the wrong spot, you should enter at the good spot. So maybe close out and relong at the bottom, but like being red or being green should never dictate your decision. That was the moral of the story. Your loss or your gain should never affect what you do in a trade. Period. Your account balance and your situation with your account does not affect the probability of a good trade or bad trade. So your being in hot water shouldn't affect your decision as to make a better trade or a different trade. Okay, I'm in the green. Maybe I should add to the position because I'm in the green. That's a dumb decision. Okay, I'm in the red. Maybe I should double down and dig my way back. It's an okay decision if you double down at the winning spot, hedge pressure. Terrible decision if you double down below hedge pressure. So it's like you have to know the difference between the two. As Livewire said, each trade is independent of each other and independent of your, independent of like your, what's it called? Of your current status, like your risk, your account size. Then what are stop losses for? Stop losses are there for whenever you take your eyes off the computer. If you leave your computer, you can put a stop loss somewhere. Our stop loss is at 448 all day long over here at the Coward House. So people use stop losses to do multiple things. Stop loss is also a very weakly taught thing. The only reason you should ever use a stop loss is when you have to take your eyes off of your trades. You need to put in a safety net temporarily so you can walk away. A stop loss shouldn't be used while you're actively trading. Just know where your stop is and have the discipline to get out. There's no reason to set an order there and while you're here at the computer, you just click the button where you want to get out. It's more practical to do that if you have the discipline. Or you can use a stop loss if you don't trust yourself to have discipline. Those are the two reasons to use one. I have discipline. You never will ever see me use a stop loss market order. I think that's a silly waste of time to do all these repetitive actions that I don't need to be doing. Put a stop loss, move my stop, move it up, move it down. It gives you the freedom and flexibility to change your bias when you know exactly where you need to stop. There's a saying, like Neil deGrasse Tyson, I love to bring this up. He was on, I think, the Joe Rogan show or something, and he has his phone, and his phone doesn't have a protective case on it. He just has his phone in his hand, his iPhone. He's twirling it around and spinning in his hand, and Joe is getting like visibly nervous. He was like, "Why are you spinning your phone in your hand? You're going to drop it, and where are you going to break it?" And he goes, "No, I'm not going to break my phone." He goes, "Well, what if you drop it in an accident?" He's like, "Well, I'm not going to drop it. That's the point." He's like, "But you're twirling it in your hand." He's like, "Well, I twirl it in my hand so I can practice paying attention to my phone so I don't drop it." Soldiers in the military learn how to spin their guns around like ceremonially, right? And they spin their guns and do that whole thing to practice not dropping their rifle. That's the reason you do that. And as if you practice holding your weapon and you learn to pay attention to it while you hold it, you don't drop it. And therefore, I don't have to have a bulky case like the rest of you because I pay attention to my phone when I hold it. So the idea is that a false sense of security allows you to be sloppy in how you approach something. Me not using a stop loss forces me to pay attention to my trade at all times. I never get off the edge. I don't feel like, well, I got to stop. I'm just going to let it ride and do my thing. I never take my eyes off of it. It's like twirling my phone. I'm not going to mess up because it forces me to pay attention. That's an advanced technique. And in reality, if you've ever put a stop loss in your trade and moved it, you moved your stop, you've completely defeated the purpose of stop loss to begin with. A stop loss is where you agree to get out on the trade. And if you change where you're going to get out of your trade, then why even do it to begin with? You're giving yourself freedom to adjust that level. Then you're not really even using it to begin with. I know where I'm going to get out at 448. So when I hit 448, I move my mouse and press the button. Also, the reason is if the market just dips really quick, it doesn't matter where your stop loss is. It's a market order. You get filled at the bottom because of the way the bid and ask works and the way the market drops, and you're a market order at the end of the line. So stop loss doesn't even guarantee you a fill at a place. A lot of times the market quickly dips. I can actually manually stop a little better. Like if you have a stop loss here and the market drops on a catalyst, imagine this. Let me go long on CPI and I'm going to put a stop 1 point under. And you realize your market order got filled 10 points under and you got stopped out -10 and you're like, but my stop loss was -1. What happened? Well, it fires off a market order and you jump in line in a huge wave of traffic and you're at the end of the line. By the time you get filled, you're at the bottom of the red candle. So even in a catalyst scenario, when markets just have spontaneous catalysts, a stop loss will really fuck your order up because you'll get filled at a very terrible spot. And I know that from experience as well. So I don't like to let the market dictate when I get out. And sometimes if a catalyst drops really quick, you get filled at the absolute worst spot, many, many points away from your actual stop loss. In fact, you have to try it out. So like, as I've gained more discipline, what I've done is simplified my approach. I don't put in a safety net unless I'm walking away. Like if I take my eyes off the computer, then I'll put a stop loss in and then I'll let it keep me out the place I want to be. But while I'm here, I maintain the idea that I'm going to always be paying attention to everything, and it keeps my eyes fluttering between my useful information. I'm eyeballing that. I'm constantly watching the things I need to be watching, with no perception of safety, because again, the market needs to be perceived With reality, what it is, it's a dangerous place. I don't want to walk in there with a false sense of security, like, okay, I have a stop at 448, I'm going to get out at 448. When the market plunges here, your 448 stop got filled at 447. Anyways, so it doesn't really serve the purpose that people think it does. It does not a guaranteed out, unless it's a stop limit. Typically stop loss market order, you get filled a very bad spot if it falls really far very quickly. So in general, because of the Neil deGrasse Tyson explanation, is that by not using that, I force myself to really, really pay attention and really commit to that. Because I know that if the market falls below that, I already know I'm unsafe. I don't say, well, you know, it's falling. Let me just move my stop a little bit. That's what most of you guys do. And that's the difference between using it right, using it wrong. So don't adjust your stop loss. If you've determined where it is, that's where it needs to be. And so like people also use them to like lock in profits as the way the trading goes up. It's not I mean, there's no system for that, and people use different, you know, methodologies for how they do that. I don't do that. I trade to somewhere and I get out somewhere and I just call it a day. And I know where I'm out. I know where I'm out. But you have to have the discipline, as Garrett has said. If you have the discipline, you're good. So I'd rather not have to carry a bulky case on my phone and twirl my phone around rather than deal with a lifetime of a bulky case. I'd rather learn to discipline myself than have a lifetime of doing one extra task every day that's practically meaningless. And giving myself the ability to be lazy and just kind of gloss over, right? Let me get my order. Okay, let me go add my stop. Well, that's a repetitive action I can do every day. Let me save 10 seconds of my life every day by just disciplining myself. So that way I don't become complacent. Does everyone understand that lesson? It doesn't mean don't use stops. It means that when you become more advanced and you're trying to hone in on your technique to be even better and more efficient, removing stupid repetitive tasks from your day allows you to focus on just the things that matter. It's one less thing I got to juggle. I just have the discipline to push the button myself. So in reality, when you actually think about it, you go, yeah, that's like a really good idea. Like this is something that you're balancing 50 different things, one less thing to do. Because I have the discipline to, after again, 14 years of trading, I have the ability to push the button every time. I don't bag hold and freeze and say, oh my God, what do? I don't know. I know exactly where I'm out. And that's always in the back of my head. Like I can leave my computer and go run and go work out for 2 hours and I'll have a stop loss at 448. If I didn't, I'd have an alarm at 449. And when it breaks it, I'd go in there and put in a stop loss at 448. Like I'm always going to be able to manage my trade the correct way. So yeah. But again, I do things differently than the status quo, but I believe the status quo is filled with failed day traders and failed educators that are bad day traders. So I don't like to really put a lot of faith and stock into like conventional wisdom. Other than I built something that works for me, and I love the idea of making sure that I can stay disciplined. Everything I do to force myself to pay attention has made me a better trader. So you have to be very careful if you're the type of trader that takes that choice. Like I don't want to use stop losses anymore because it'll allow me to be lax and lazy and just kind of like, you know, it's a habit of let me automate some of these things. I'm in the mode of let me force myself to watch this and don't take my eyes off it. Like Nicole today went to go make some breakfast, took her eyes off of it and dealt with that. I don't want to tell her while she was here, like, you know, don't, you know, you kind of mess. I mean, she's learning as she goes, right? She's learning this. She's like, oh crap, I gave up a bunch of stuff. And so it's like, well, when you leave, you know, maybe take some profit. Even if you're not putting a stop here, take some profit. If you have to leave, lock something in. Anytime you take your eyes off of it, you need to do something, right? So you learn this as you go. Alrighty. Let me see. 6 p.m. But there's a reason you guys are here learning from me, and y'all are going to learn some different ways to do stuff. All right, guys, gonna call the day. We'll have a Zoom call in about an hour or hour and a half at noon, and we'll meet up and we'll chat then. I love you guys. We'll see y'all later. Thanks for tuning in. Remember, we're gonna do recorded Zoom calls as a Pro Plus feature going forward. So make sure you guys join the Pro Plus package to get all your futures data, risk interval data, yellow line data. Now we have DD band break alerts. Super awesome. I'm waiting so long to have these things on the platform, and I'm excited to have them now. It's great to have. And now we're considering recording Zoom calls in Pro Plus. The Pro Plus package is really getting beefed up. You get your own money's worth. So I highly urge you to check it out and join it up. In the extended trial, send me a message. Like I said, we're we'll show you how to upgrade, etc., etc. We should be good going forward. All right, love you guys. Thanks for tuning in.